Mr. G. Shivakumar, ED and CFO of G Shipping with us on the show to talk about all that and their quarterly numbers. Mr. Shivakumar, great having you as always. Thanks for taking the time out.
Good morning, Neeraj. Thank you for having me.
No, the pleasure is entirely ours. Just a bit about what's happened in the last 15 days, then we come to the quarter as well.
Yep.
But last 45 days rather, let me put it that way, because now you have the benefit of talking to us for 4.5 months and not just 3 months. Yeah. What's happening around the world? Because demand concerns seem to be galore out there.
That's right. That's right. So we've had one of the things that we've seen and which we've been surprised with is global oil demand, which is been fairly weak. We were expecting 1.2 to 1.5 million barrels a day for the year growth, and it's been pretty weak. And a large part of that is contributed by China, which has had very poor oil demand growth and probably negative oil demand growth actually year to date. So that's a bit of a concern for us. We'll have to see how that trend plays out. Apparently, EV sales are pretty strong in China. We don't think that should affect oil demand that much, and maybe there is some underlying issue. So we have an issue with oil demand. We also have an issue, not too much of an issue really, with Chinese steel demand. While steel demand hasn't been great, so that's end user demand, iron ore imports have been reasonably steady. Coal imports have been up. Bauxite imports have been up into China. And China, of course, is the big consumer of dry commodities. And so it's a mixed picture. But anyway, the situation is not looking very hot from the demand point of view. Again, we'll wait for winter to play out. Normally, a much stronger period for commodity demand, especially oil.
Yeah. So that's the Chinese picture, Mr. Shivakumar. What about India? I'm just trying to understand, how India is concerned, because some of the concerns for OPEC also include reducing in demand from India. Are you seeing any of that play out?
No, not really. We are seeing Indian demand is pretty steady. It's growing year on year.
Okay.
Coal demand has been growing year on year. So we've been seeing coal demand, coal imports growing year on year. So from that point of view, I think we are fine on the demand side. Again, the volumes don't compare, and that's a critical thing. That because China is so big in commodities that even if India is growing strongly, it's difficult to compensate for.
No, fair enough. I'm talking about India volumes compared to India volumes, say, last year.
Oh, the volumes are pretty good. The volumes are pretty good. The volumes are growing. That's right.
That's heartening,
that's
truly.
Right.
But one part of the, I think, cloud on the horizon is demand. The other is ongoing conflict.
Yeah.
Right, and what it's doing not just to demand but time, etc. Give us a sense there on whether the worst of it is over or just yet to come for you in terms of profitability. We've seen some impact on your quarterly numbers as well.
So nothing's happened with the conflicts in the last quarter.
Yeah.
So typically summer tends to be a little weak for the oil tanker business. So the conflicts are what they were, and we are seeing that Russia-Ukraine is still going on. The Red Sea conflicts are still going on. The Houthis are still shooting at ships that pass by. So those impacts are still on. We wait to see what can happen next year on geopolitics once the new president is in place. In any case, for us, all of these are sort of transient. We are looking, if anything, we're looking for market weakness because we would like to. We've deleveraged so much in the last 3 years with the strong profits, and we're just sitting on our resources. And we're waiting for the right opportunities to buy. So we'll look for those opportunities, and we will, if we get those opportunities to buy sooner, it's great.
Okay. So, just before I probe that point though, just one quick follow-up. I would, if the current market scenario until winter shows itself is sluggish, I'm presuming that because of geopolitics, insurance costs, etc., must be high, while freight rates are lower as well. Is this gonna impact the near-term performance for your company as well?
Yeah, so yes, it will. A very large part of our capacity, the tanker capacity, is exposed to the spot markets, which is spot freight rates. And if we have weak freight markets, it will certainly affect us financially.
And they are weak
on the
right now,
results.
right? Freight rates are weak right now? Crude freight
They are-
rates must be
Yeah,
around what levels?
Crude freight rates are probably around the $35,000 a day level, which is not too weak. But in comparison with last year, they're a little weaker. Product tanker freight rates have been struggling in recent months, probably around the $10,000 to $20,000 a day range, while they were in the 30-ish range a year ago.
Okay.
So that's a little weaker than it used to be. And that could affect, as I said, a very large part of our fleet is exposed to the spot market. And that would affect the financial results for the quarter or 6 months, so on and so forth. But again, as I said, in the longer term, we are okay with that because it gives you the opportunities to buy.
So so I would love to know this. Your numbers, so your balance sheet shows, in some sense, your ability to be able to acquire assets. What is the strategy? Is it string of pearls, smaller things, or are you looking to make larger vessels acquisition? And in this, do you reckon this happens in the second half of the current financial year, or does it get pushed?
It takes time. We'd like it to happen sooner rather than later. But unfortunately, these things take time to play out because it takes time for the weak earnings to start affecting asset prices and for those to come down. And remember, they've gone up a lot in the last 3 years. And they've just doubled in the last 3 years.
Because of lack of capacity creation, or what is it?
No, it's just because the rates are so strong. The rates are so strong that it makes sense to buy ships. You're buying ships last year, based on last year's earnings, you were buying a product tanker at 4 times EBITDA. So, and that's why the prices went up. And now if the rates drop off, then that price is difficult to sustain. It'll take time because people then need to give up hope on the market and start selling down. So you'll have to wait for those to happen. It's like all markets, really.
Yeah. So while you wait for that supply-demand situation to sort of ease out, just coming back to your freight rates, this is what you see in the foreseeable future, especially for the product business? Any changes you see there? Of course, you said some demand will go up in winter, etc. But what is the outlook on freight rates?
Yeah, typically this demand goes up in winter. It's not yet happened. And so we'll have to wait for that.
They are in winter for that.
That's right.
For that
That's right.
matter.
You're already in November. You're already in winter now, and that's why we'll have to see that it's really finely balanced. Doesn't take much for freight rates to go up a lot because the market is finely balanced. You know, just a 1% change here and there makes rates go up or down a lot. And so while all I can say is that the markets today are weak, and we don't know what they will be by the end of the week. And that's how finely balanced the market is. It can go from $10,000 to $40,000 in the space of a week.
Okay, that you're talking on the product side. But on the crude side, it's pretty steady.
Crude is pretty steady. The same can happen with the crude tanker markets, that it can just go up just like that. You know, suddenly 5 extra cargoes appear in the market, and the rates will just go up because all of these are time sensitive.
Sure, but you are seeing global demand being weak, not just China, isn't
That's right.
it?
That's right.
Apart from India, which you're saying is one outlier, but Europe and all over you're seeing global demand being weak?
Yes, it's been weaker than would have been expected. That's right. It has been weaker than I think the rest of the world has gone about according to what would have been expected. It's only China that is dragged down. So you're about 500,000 barrels a day below what you would have penciled in at the start of the year, and that's all coming from China, really.
Mr. Shivakumar, there is a new player in town, and that is the US president. Now, if indeed tariffs happen, and Xi Jinping's comments with Joe Biden were interesting, willing to work with Trump, but don't cross the red line, so on and so forth. Love to understand, how is your industry kind of thinking about this / bracing for this?
Yeah, that's an interesting thing. So we've seen tariffs before, again, not on the scale that is being spoken about now. Tariffs typically are on finished goods, and we are not in the finished goods business. So that could come on steel. Steel is a small part of dry bulk cargoes. The last time we had tariffs on finished goods where President Trump levied tariffs on Chinese goods, China put counter tariffs on grain from the US, which is a big export commodity from US to China. What happened is that the US continued to produce the grain, China continued to need the grain, and so the trade patterns just changed. So China imports from Argentina, US exports to somebody else. And just the market trade patterns change. Sometimes these things can actually be good because without these tariffs, everything is happening the most efficient way possible. And as soon as you have this externality that's coming, then it becomes just a little less efficient. So, you know, it can work either way.
And you're saying that's good for demand?
It's good for demand for ships. That's right. Yeah, that's right.
Okay. Just one follow-up there. Any other patterns that you expect to get replicated from 2016? The world loves to hypothesize what happened in 2016 and what can happen now. Anything else that you see in that aspect?
So the other thing is renewed enthusiasm for drilling for oil in the US.
Oh, yes.
And that's, again, great for crude tanker markets typically, because that's going to get exported. And US exporting, the big imports are in the Far East and in India. And again, this is a long-haul trade. It's the ideal scenario that you have, you know, extra cargo being produced from a region that's far from the consuming region.
Yeah.
So that would be, again, good for crude tankers.
Trump is great for you, basically.
In some of these ways, yes.
Yeah,
but again, you don't know what else knock-on effects these have.
Okay.
Then we'll have to.
So when you say knock-on effects, for example, if tariffs are increased substantially from around the world for imports into the US and you have volumes dropping there, that becomes a potential problem.
Or if you have, because of tariffs, you have slower economic growth, let's say in a big consuming region like China, and then you have imports of commodities dropping off, then you could have an issue where overall growth of GDP growth is poor. Because the global macro at the end of the day still matters for commodity demand. And that's something that we'll have to keep a watch on. Again, as I said, it's okay because we are positioned either way that if the markets are good, we continue to collect cash. If the markets are bad, hopefully the ship prices go down, we get to do a lot of capex, and then we increase our capacity.
I love that you're so zen about global demand slowing down from the largest economy in the world, or one of the largest economies in the world. But yeah, great way to see the glass half full or half empty.
Yeah, this is how cycles work, right?
Yeah. All right. So that's G. Shivakumar, ED and CFO of GE Shipping. Great insights there on what's happening with global trade and, of course, their numbers as well. Some are expected to be a weak quarter, and maybe we'll see some improvement next quarter as well.